Hello and welcome back to FX Limit, your go-to channel for all things Forex trading. In today's video, we're diving into the fascinating world of harmonic patterns, specifically focusing on the Butterfly and Gartley patterns, and how you can use them to identify potential reversal points and trade opportunities using technical analysis. So, grab your notebooks and let's get started. First things first, what exactly are harmonic patterns? In the realm of technical analysis, harmonic patterns are geometric price patterns that use Fibonacci numbers to predict potential reversals in the financial markets. These patterns are all about symmetry and precision, and they provide traders with insights into market cycles and their turning points. Among the plethora of harmonic patterns, the Butterfly and Gartley stand out for their effectiveness in the Forex market. Let's break them down one by one. Starting with the Gartley pattern, named after H.M. Gartley, who introduced it in his book, Profits in the Stock Market. The Gartley is a 5-point retracement structure that resembles an M in an uptrend or a W in a downtrend. The key to identifying this pattern is to look for specific Fibonacci retracements and extensions at each point. The critical aspect of the Gartley pattern is the point D, where the pattern completes and where traders should pay attention for potential trading opportunities. Now, let's move on to the Butterfly pattern, which is considered an extension of the Gartley pattern. The Butterfly pattern is also a 5-point retracement structure, but with a more extended outer wing. The pattern resembles a butterfly with its wings spread, hence the name. In this pattern, the final leg is often an extreme move and offers traders a high-probability reversal zone. So, how do you trade these patterns in Forex? Here's a step-by-step approach. Identify the pattern. Start by identifying potential Gartley or Butterfly patterns on your Forex charts. Use your Fibonacci retracement tool to measure the potential points and ensure they align with the specific Fibonacci levels of each pattern. Wait for pattern completion. Patience is key. Wait for the pattern to complete at point D. This is usually at a significant Fibonacci level, like 61.8% or 78.6%. Confirm with additional indicators. Before jumping into a trade, use additional indicators like RSI, MACD, or stochastics to confirm that the reversal is likely. Look for divergences or overbought/oversold signals. Entry point. Once you have confirmation, the entry point for your trade is typically at or near point D of the pattern. Set stop loss and take profit. Always manage your risk. Set a stop loss just beyond the furthest projection of the pattern. For take profit, use previous support or resistance levels, or return to the start of the pattern. Monitor the trade. Keep an eye on market developments and be ready to adjust your strategy as needed. Trading harmonic patterns like the Gartley and Butterfly can be incredibly rewarding, but it's essential to remember that no strategy is foolproof. Always use proper risk management and never risk more than you can afford to lose. In summary, harmonic patterns offer a unique way to look at price action and market psychology. By using the Gartley and Butterfly patterns in your trading strategy, you're tapping into a powerful method of forecasting market reversals, allowing you to make more informed and potentially profitable trading decisions. And that's a wrap for today's video on FX Limit. We hope you found this deep dive into harmonic patterns insightful and helpful for your Forex trading journey. If you have any questions or want to see more content like this, don't forget to like, subscribe, and leave a comment below. Stay tuned for more trading tips and strategies. And remember, keep learning and keep trading smart. See you in the next video.